Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor. This is Dentist Money. Now, here's your host, Reese Harper.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, Reese Harper, here with my trusty old co-host, Sir Ryan Isaac.
Hello. Good morning. Howdy.
How you doing, sir?
I'm doing finger guns at you for those at home that can't see it. What's happening?
Good morning to
Like
you. And I'd like
gun.
to also extend a trusty good morning welcome to Q in the studio.
A hearty
Top of the morning
yeah
to you.
Good morning.
The voice of the common man.
We have a story today about a massive failure.
Your life.
It's my life. Spoiler alert, guys. This is a story about my life. A massive failure. Story of my life.
The young and still restless.
A brief synopsis.
Okay,
my
so
failure
let's
of a
tell
life.
this story. I will
Get close
say
to
that
home, man.
This one was a Wall Street Journal story that really kind of stuck out to me a few weeks ago as I perused through my evening mobile application. It's kind of got me addicted because the new user interface is beautiful. If you haven't really ever downloaded it, shout out to Wall Street Journal.
Shout out to Wall Street
They are not
Journal.
a sponsor, in case you're wondering.
Soon to be.
The story was about a $2 billion hedge fund and a few insights into it. And I'd like to let Sir Ryan Isaac share some of his thoughts on the story.
Well, I mean, here's the thing is it's the story of a $2 billion hedge fund that lost everything. And in the history of private funds like this, there's only, I mean, it's a single-digit number of funds over $1 billion that have ever done this.
Yeah.
I mean, this was backed by a massive bank. Which
Is it okay to talk about these names?
Yeah, well, yeah, Wells
So
Fargo.
it's public data.
Yeah, I'm just laughing because the news today on that bank isn't very.
So
they've had a bad string of bad luck.
We love, all of you Wells Fargo people out there. Shout
you.
out to our friends.
You weren't
We
opening
love
the
you.
fraudulent accounts.
You didn't open the fraudulent
Our friends
accounts,
weren't doing
okay? But Wells Fargo got thrown under the bus from this story.
It's been
somewhat.
a bad
Actually,
news cycle.
It was mostly Wells Fargo
It
had
wasn't
a
Wells
problem
Fargo.
with accounts opening, but Wells Fargo lent a lot of the money to this hedge fund.
Yeah.
The hedge fund was a leveraged hedge fund that purchased oil and gas wells right before the energy market crashed.
Yeah.
And this was, I think it was in 2013. I didn't write down.
Well,
the
it was
year.
the company though that managed these oil and gas wells. They've been around for a long time actually, and they'd been very profitable and had made good returns for their investors over a long period of time. But they were a lot smaller. They just got really big really fast because of leverage through Wells Fargo. But yeah, they had managed different assets for decades, and then the way they did it was interesting too. The article pointed out that usually when funds like this go and borrow money to grow bigger like this, they won't commingle different assets or different funds. Like they'll start a new fund, and they'll raise money as part of this new fund. So if that one goes bad, the creditors can't go get the other funds. In this one, they gathered everything they had. So the funds were basically tied to every oil and gas well they had everywhere, all the equipment, all the land. I mean, it was everything. That's part of what made it so tragic.
Yeah, this was the fund was called the Enervest Fund,
which they had been around. Enervest had been around for a long time.
This was a really sophisticated pool of investors as well, right? That's kind of probably the most important point of this is that some of the investors included Wells Fargo. We'll call them an investor because they were the ones that allowed the fund to lever up. Mm-hmm. But there were also equity investors like the Orange County, California retirement system, which is a huge public pension, Canada's second largest pension, Florida's largest pension fund manager, Michigan State University, Arizona State University, the Paul Getty Trust, Catherine T. MacArthur Foundation,
foundations,
and the Fletcher Jones Foundation.
Yeah.
And all of these collectively there's some of them, I mean, these are very sophisticated institutional investors, and this fund is going to end up being worth single-digit pennies on the dollar.
Yeah.
By the time everything goes through bankruptcy and Wells Fargo gets all of their money
back. You know, and even the owners went back. The two of the owners went back and tried to put in $85 million of their own money to give to Wells Fargo and be like, can we salvage? Can we just keep something going and make it okay? And it just wasn't enough. Can you imagine that?
I read that and was kind of, I mean, you could tell they were trying, right? I mean, wasn't poor intentions. I think it was they were just super disappointed. It was one of their, I mean, and the point isn't here. This was not a Ponzi scheme. This was an aggressive investment.
Well, this is a company that had done this same line of business for a long time. It's just they hit a point where they're like, okay, we think we can quadruple down on our investment, more than double down.
Yes.
And go really, really big on the bet that this sector of the economy that we're in, oil and gas and energy, is going to explode. Because, well, what I thought was interesting too, it's kind of relatable to the everyday investor, is they were doing this at a time when oil was really expensive.
Yeah.
And it's kind of like the investor that like waits on the sidelines to invest and finally sees the market start going up and up. He's like, now I feel comfortable.
Yeah.
Now I'll put in all my money from business cash,
Yeah.
And then
totally. Yeah, I think that's one of the like takeaways here is that even smart people, even super smart people, are really susceptible to big investment mistakes when they don't stick to basic and time-tested investment principles. When you're levering up and you're going into one asset class in hopes that you're going to strike it rich, that's going to put yourself in a lot of risk. And a lot of these public pension funds, they couldn't handle that kind of risk. They're already in a tenuous position.
Yeah.
And a lot of them were not risking money they could afford to lose, but they were trying to recover from low interest rates that they're getting, low returns that they're getting from a lot of their fixed income in the rest of their portfolio. They're not able to make these pension payments as easily as they might have been in the past. So they're trying to make this, they're trying to knock the ball out of the park in this one sliver of their money so that they can make up for the lower returns they're getting elsewhere. And instead of having something good happen, you end up putting even more money at risk.
It was bad for some of these guys. It was a lot of money.
So I think you've gotten the point of our story, hopefully, and it was an interesting one that was pretty unusual for the last 15 to 20 years. Like we said, this doesn't happen at this scale very often.
Yeah.
And I think today we're going to try to cover 3 takeaways from this story that we can apply to dentists that we think are really relevant. How about you start us out with the first one?
Yeah. So the whole point of the discussion today is that even really smart people can make the mistakes, like you said. So point number 1 is that trying to predict market returns is always dangerous, even if you are really smart. And not just maybe market returns, but trying to predict the future of the economy or world politics or how it affects the market or business cycles. It's just a dangerous game to play with historically really bad consequences for even the smartest, biggest, most sophisticated investors.
And that's why I liked sharing this story, because I think the most of the time when you say don't try to predict market returns, a lot of the feedback we get is, well, I do my research, or I actually really enjoy this though, and I spend a lot of time doing it. So I know that it's dangerous, but I'm a little bit more sophisticated and more informed than the average person.
Which we'll talk about. There's some good research about that. Yeah.
So I think it's human nature to make predictions. I think we all like to. It's fun, betting on the outcomes of different things.
Yeah.
And,
well, I think that's a big part. You just said that. Like, you have those conversations with people, and they say, I do my research, I'm really smart at this, but it's also kind of fun.
Yeah.
It feels nice to gamble a little bit.
I like to bet on which person is the last person in our office to make it up the mountain bike trail. Okay.
And everyone looks at me in the room. I get it, guys. I don't know how to shift down in my gears.
The basics.
I didn't know the seat is supposed to sit higher when you climb. You're supposed to lock in. I didn't know that. Okay?
But we bet on you, but you weren't the last one up. I think
you have some insider information on that bet.
Yeah. You guys rigged my bike, so I'm a newcomer. I didn't know. I did beat someone though.
Yeah, we throw you. We threw that race.
Fine, that's good company to be in. No, there was a really, really good podcast done by Freakonomics a few years ago. It was called "The Folly of Prediction," and it was cool because they interviewed people around the world in really different industries and that made a living making predictions. Like, they interviewed people in Russia that were gypsies that did fortune telling, and they made a great living doing it. So they interviewed all these people who make a living doing predictions. And I thought it was funny in the text of the podcast, they started out with, fact, human beings love to predict the future, and fact, human beings are not very good at predicting the future. And it was funny because they traveled the world, interviewed all these people who make a living predicting the future, and that was their takeaway. Human nature, we love to do it.
Yeah.
But we're also really bad at doing it.
And you're really bad.
I'm terrible.
I'm a little bit better.
I have some picks for tonight's games.
So,
call it. Yeah.
So another fact that was in that, I think that was interesting,
the
is
incentive part of it.
They said because the incentives to predict are quite imperfect, bad predictions are rarely punished. This situation is unlikely to change.
Yeah.
And I think this is what we see a lot in the overall financial press and financial news, is that bad predictions about the future are rarely punished. People don't hold the media doesn't hold bad predictions accountable.
Yeah. So they were saying, what if on financial media, every time someone comes up for an interview, they had a little tally by their face, like a little number, a score, and it's in red on the number of bad predictions they've missed, Like the guy comes up and he's really smart, but he's got like a -17 in big,
Yeah.
Like what if we did that?
Yeah, I could see like a positive number for the black right next to a negative number for the red.
Yeah.
And you'd see like, okay, he's gotten 2 right and he's gotten 27 wrong.
Yeah.
Because that's just
like
the
that's
nature
how we'd
of
score it. But it goes unpunished. People can someone can call the downfall of the Western civilization and the economy and the collapse of the world for every year, and it doesn't. Goes unnoticed.
Yeah, I think that's an important kind of point, is that you can make a poor prediction and just say it over and over and over, year after year, month after month. You can just say it for a long time.
Yeah.
And no one will stop listening to you because they're just like, man, he probably really might know what's coming.
Well, especially if you're smart. If you have a compelling way to tell the story.
And that's what's kind of ironic. I think I want to slow down on this point just for a second, which is if you make a prediction about the decline of an economy, okay, and you say that this is going to be one of the worst years in stock market history. You could say something like that, one of the worst years in stock market history. Okay?
Yeah.
And that sounds kind of severe, right? But if you said that every year of your entire life and kept saying that, you're going to be right.
Which people do.
Yeah, people do that.
Make a
career of it.
Yeah.
Just like the gypsies in Russia predicting fortunes.
Yeah.
You say it every year, and probably once or twice every decade, you're going to be right.
Statistically, yeah, that would be once or twice a decade.
Yeah. So, people will look back and be like, he knew or she knew.
Yeah.
That look at how she was able to predict.
Well, and that's the funny thing. What are the incentives for when they finally get it right? They get book deals and, TV shows and, interviews, and they're high profile people, Now there's not the tally score.
Totally. The point is, there's not really a punishment for getting it wrong. There's just a ton of upside for getting it right, and you're going to get a bad prediction about financial forecast. You're going to get it right periodically, just by the nature of averages. And you'll be able to find some redemption, and people will call you a hero for a while
at some point. So I was thinking about a story recently. I was talking to a client, and he was relating a conversation that he was having with another dentist friend of his. And they were talking about the fact that this client had hired an advisor, and his friend kind of directed his own investments. And our client was telling me, I think he could probably maybe use the help, or we were just having this conversation, and his friend was telling, well, I pick my own stuff. I do my research, I do my own, I pick my stocks, and it's kind of gone pretty well. And this just kind of got me thinking about, I think that's a common belief, but I'm not sure it's because people really believe they have some great ability to predict the future. I think what happens a lot of times with average everyday investors is you'll start with maybe a small amount of money. Maybe it's the first little bit of money you've saved after the practice is open and finally paying back some debts, and you have some cash flow. Maybe it's 20 grand, maybe it's 30 grand. You pick a handful of stocks, they're well-known companies. You happen to do it in a nice bull market, and it does well,
Again, 7 out of every 10 years, you will do well and feel good about it. Because
statistically, it's a pretty good, if you do it and then just kind of sit on it, statistically, it's probably going to end up okay at some level. And so I think what happens with a lot of people is they start doing this with small amounts of money. And two things either happen. They either feel pretty confident about that, and which can lead to some bigger mistakes down the road, doing the same things with larger amounts of money.
You mean they'll gain some overconfidence?
Yeah.
And then
I picked 5 stocks 7 years ago. They seem to be returning pretty well, and then kind of keep doing the same thing. Or I think what happens too, more commonly, is, and this is what I was telling our client. I said, over time, what'll probably happen is your friend who felt really good with 50 grand doing that with a few stocks, business cash will get up to 250 and 3 and 5 and 6 or whatever, and he's probably not going to feel as confident doing that. The
larger the money,
it's so hard.
Becomes harder.
Yeah, to pull the trigger. So then what happens? Then you end up kind of still trading a few, a tiny portion in your stocks but then the other huge amount of cash sits around, or you start just throwing money at other things because you're like, I don't really feel confident in that thing I used to do when it was small. And so, you make choices you wouldn't otherwise make. You leave too much cash around, it becomes inefficient. So I think either one of those paths, I think that's just a common way people start out, and.
Well, one of the quotes from the Freakonomics podcast that I thought was really good, and it says, from the economy to the presidency to the Super Bowl, educated and intelligent people promise insight and repeatedly fail by wide margins. These mistakes and misses go unpunished, both publicly and in our own brain, which has become trained to ignore the record of those who make them.
Yep.
And I think that's kind of maybe the
chime.
The C for Chi I'd like to do for today.
No. That wasn't a C. Good. So you're training me. You're faking it. Yeah, that was
a G.
Yeah, that was clearly.
There's a C.
Thank you.
So
listeners know by now.
Listeners know by now.
C
I'm trying to trick Ryan.
Yeah.
Teaching him music here along the way.
Thank you.
So if you can kind of remember this first point, that it's just really, it's easy to make bad predictions about the future, and statistically, people will get those right periodically. But I think it's also easy to get overconfident really quickly if you make some kind of an investment decision and have a good result. And statistically, quite often, the averages are that you will have a good result when you invest your own money in a stock or in any kind of investment. Statistically, if it's a public investment, the rising tide raises all boats, right? And that's what you'll see is that stocks perform well on average.
Well, that's and that's not an uncommon conversation. The one I was mentioning, I've had several of those conversations where someone mentions, I don't know, about 7-8 years ago, I bought a handful of stocks and I've done really well. I did my research, I picked the right ones, and I've done really well. And it's kind of like everything's done pretty well.
Yeah,
for 7 or 8 years.
What you have to be asking yourself is, did you do better than the overall market did?
Yeah.
Or did your stuff go up?
Yeah,
because the overall market,
that's a good question.
Has the really is the tide, right? That's rising. The question is, did your investments rise higher than the tide, or just at the same level as the tide, or not even as high as the tide rose?
Yeah.
And I think that's the thing that kind of goes left kind of unacknowledged, is just because you have something that goes up, or even if you have something that goes down, it doesn't necessarily mean that you're as good or worse than the averages. You just need to compare what you're doing to the right benchmarks before you start giving yourself credit for predicting the future.
Well, and the acknowledgement, I think it's hard to see far down the road when the practice is just getting started, you're first starting to make money. It's hard to see the fact that if you have a healthy savings rate, you will have hundreds of thousands, if not millions of dollars at some point in your working career. And I think it's hard for people to, realize that what you do with 25 grand will not feel the same with 250 or 500 or $1 million at all. So
one more quote that I wanted to leave from Steve Levitt, who's one of the authors of Freakonomics. He said, "So most predictions we remember are ones which were fabulously, wildly unexpected and then came true. Now, the person who makes that prediction has a strong incentive to remind everyone that they made that crazy prediction which came true."
Yeah.
If you look at all the people, the economists who talked about the financial crisis ahead of time, those guys harp on it constantly. I was right, I was right, I was right. But if you're wrong, there's no person on the other side of the transaction who draws any benefit from embarrassing you or by bringing up the bad prediction over and over. So there's nobody who's got a strong incentive, usually, to go back and say, here's the list of the 118 predictions that were false. And without any sort of market mechanism or incentive for keeping market predictors honest or prediction makers honest, there's lots of incentive to go out and make these wild predictions.
Just keep doing it.
Yeah. So I think it's just an interesting way of thinking about the business of making predictions and try not to let that affect you too much.
Okay.
Let's kick into the second point of why what smart people can do to err with their money.
Yeah, well, the point is that smart people can get caught up in the hype just like anyone else can.
That's the second point, not the point.
That's the second point.
Yeah.
I'm
excited about this second point.
Well, you go back to the original hedge fund story, and you had some of the largest and most competently ran funds, pensions, charitable foundations that got involved one after another into this pretty speculative investment, you know?
Yeah, and I think that was a somewhat of a herd mentality. Mm-hmm. Okay, that's what we're talking about when we say the hype. When smart people do things, other smart people do them.
It's kind of a gravity to it, isn't there?
Yeah, I mean, you can,
which is fair.
Bernie Madoff was primarily that kind of herd mentality, a gravity, right? It's easy to sort of feel pulled in magnetically by other smart people doing smart things, right? And and you don't want to be left out, and you don't want to be the person that didn't see it, and you're working so dang hard every day that if you can find a way to get a little bit of an edge and just not have to grind so hard getting these like mediocre, like, 7% returns.
7% returns.
You just don't want the market rate. Heaven forbid you actually made like 10%, you know.
The market
or 4.
Does,
just getting 4. Yeah. Like
save 30% and get 4.
My prediction for that I usually make is most people. This is a prediction, a bold prediction.
Okay, here we go.
So you might want to jump on this bandwagon.
On the prediction episode.
But if most people would just not lose money and make 3% a year, they would probably be wealthier than the average person
who's trying really hard to get a high return.
Yeah, if you just didn't lose anything.
Okay.
Everyone listening, have you ever lost money doing one thing that's been stupid? If you can think, at least 7 out of 10 of you listening to this are like, yeah, I did that one thing.
Yeah.
And it didn't turn out well, and my money's now
just
gone.
Don't ever do that.
Yeah, if you didn't do that thing and you just took that money back and you took all your money and you made 3% a year, my guess is that would be more money than what you'll have because you lost that money.
Not an invitation to put your money into insurance products as your investments.
Not an invitation to make bail. 3%.
Not an invitation to bail if there's volatility. It's not the same as losing money. But I agree with you. And we talk about this a lot with clients. I think people would be surprised to know how much smaller the rate of return required for them to hit a work optional point in their life. If their savings rate is high enough and if they can avoid some mistakes, then it's smaller than they think it probably is.
Totally. So a couple weeks ago, we talked about, we had a podcast called 7 Signs You're About to Get Hosed.
Very serious podcast.
It was a viral title. I'd like to give that credit to Q.
Thank you.
And then secondarily, I'd like to give the credit to me for reading through the 30 titles and being like, that's the perfect title.
I like that phrase. Secondarily, I'd like to give the credit to me.
Okay, fine.
I like that phrase. We should start the podcast with that.
That's the sign of a great leader is taking credit.
We've talked about that. A great leader takes credit for all of the work of everyone else.
That's not true.
Okay, yeah. 7 Signs You're About to Get Hosed. You can find it on dentistadvisors.com/listen.
Well, it's funny because one of the things that you guys talked about a couple weeks ago was that a lot of times it's compelling when somebody with like a big name is involved with an investment. And literally like 2 days after we recorded that show, we got a call here from a prominent former NFL star. And this isn't something that happens all the time, but it was just interesting timing. He's involved in this hedge fund opportunity, and we got the call like 2 days later, and it might be a very viable opportunity, but it was just interesting. It was kind of an interesting
Well, we just talked on the show about how there can be a herd mentality, and a lot of times in certain investment, sometimes scams, sometimes they're just legitimate opportunities. You'll have a famous person. It could be a famous wealthy business person. A lot of times athletes, ex-athletes will be involved. And we had just finished recording that. And then there's a local, it's a very widely respected local charity event. They're raising money for charity and some other things. But it was funny because it was the next day that a very famous NFL star called the office.
Highlighting. To
talk about but it was just kind of funny that we had just barely gotten done talking about that. So,
well, and I think what's important is, if we look at what drives people to participate in an investment, sometimes it's a headline person, and there's nothing inherently wrong with that. To like have
Although I think Mike Tyson is pitching cryptocurrency these days. I think so. I think he's the face of some cryptocurrency.
We've had our fair share of content around here about former NFL players and their kind of prominence in the investment world. We had an article that was in was it in Dental Economics?
Dental Economics.
About John Elway and his history, and it's interesting just how a big name goes so far in making people feel like they need to get involved in something, and so I think dentists can get caught up in the same hype though, and I think that when dentists look at other prominent dentists or other well-known entrepreneurial dentists, and they see that they're expanding and that they're opening more locations, or that they're expanding their footprint and trying to do something innovative or creative, you end up sometimes feeling like maybe you should be doing that too, or maybe you should be doing what someone else is doing that seems to be smarter or more sophisticated, or a better plan, and that can send mixed messages. I think if we compare ourselves too much to other people around us and the things that they're doing, especially business owners, when business owners compare themselves to other business owners and try to almost have personal judgments about their own success based on what other people are doing, it can really cause people to make a lot of mistakes.
Well, yeah, I think that's a good example. I talk to a lot of dentists that call our firm for the first time, and I'll hear that comment a lot, like I've got one location, it's going really well, I might have a partner and associate, but isn't the way to go like a bunch of locations? Isn't that the way I'm supposed to do it? Isn't that the way to build wealth? Is I need 10 locations and then sell to some private equity later? I hear that a lot. There's a pressure to kind of follow what some of the bigger opportunities are, and it could be for some people, but I think to your point, you end up, when you do that comparison, you end up ignoring or not placing a value on what your own strengths or talents or what your own personality is too, you know? And you can't go against that grain for too long, too much, or else it can be disastrous.
I think you see that quite a bit, and I think it's important to just kind of be comfortable with who you are, get as much advice as you can from people around you, giving you feedback, and take the consensus of kind of all that advice and what you feel, and then just gain confidence in your own plan. And just get a sense for what you want to accomplish with investing. And
well, I was going to say maybe that's the takeaway then, as a dentist is exploring an opportunity, maybe as an investor or as a business owner, an entrepreneurial endeavor, to just get a lot of feedback. And maybe it's fair to say that if there's not at least someone in your circle of feedback loop that's giving you pushback, not just agreeing, like that's a great idea, bud, but someone is actually questioning it, then maybe find someone that will a little bit.
I think you need people that don't agree with you every time. Yeah.
Okay.
So the third tip today that we want to talk about how smart people err is when they become a little overly opportunistic.
Excited.
Yeah. Is excited and opportunistic
I don't
the
know.
same word?
I feel like if you're being opportunistic, you're like excited about something.
Yeah, I think you're probably right.
Maybe a little overly.
So let's define it this way. When someone's being opportunistic, they're basically saying, I know that I have more information than someone else, or all the other investors don't know as much as me. They don't have as much information as I do. So I'm going to take advantage of a situation.
Yeah.
I'm going to take advantage of something we call a mispricing.
Yeah.
That's how fancy economists or finance people talk about.
That's how we talk normally day to day.
Mispricing.
Yeah. We say that word a lot.
After we eat our sorbet.
Yeah. We say mispricing.
And our escargot.
Yep.
So this is where we talk about the difference between an efficient market and an inefficient market. Now, you've heard this podcast before for all of you longtime listeners, so we won't make it lengthy.
And you'll hear it again in the future.
You might. There's a possibility. When markets are inefficient, it's possible to know more than someone else. It's possible to know more than other investors in a group because you have more information than they do. That means that information is scarce. Let's give an example. Ryan, do you have an example of an inefficient market?
Do I have an example? I do have an example. But to clarify what we're saying is that there is a possibility to take advantage of a lack of information or a mispricing, like you were saying, in an inefficient market. An inefficient market has fewer transactions, less buyers and sellers. It happens less frequently. There's less information. So there's this documentary on Netflix. I don't know if it's still on there. It was really cool. It's called Sour Grapes. And it's this documentary on how the first ever case of someone being convicted and put in prison for wine fraud ever in the history of the world. It was this young kid from California in his 20s who had he was taking old bottles, like recycled bottles, and he was with a chemist mixing. He was really good at it though, and the kid had talent. He was mixing wines, like cheap, newer wines, brand new wines, to taste like older ones, and then he was getting old corks, and he was waxing everything, and he was aging everything, and for years he kind of had a little bit of help from other people who knew what was going on that was auctioning off these wines. He sold tens of millions of dollars worth of fake wine to some of the country's wealthiest people. And it's crazy. They would go into these wine cellars of these wealthy people and show, $20 million worth of wine in the cellar, and a quarter of it would be fake from this kid in California. And he did it for years, and there's footage of him. And the point about the inefficient markets is that, and he specialized in, I'm not a wine guy. Shoot, I can't remember what kind of wine it is. He specializes in a type of wine that's pretty rare. And so the point is that there were so few transactions taking place in this wine, and he was dealing in wines that were from the 40s and 50s and 60s. I mean, so few transactions, so little information known. He actually got away with selling bottles of a particular brand, claiming they were from the 40s, and they didn't even start manufacturing until the 60s, and no one caught that for a long time.
Interesting.
And these were people who frequently bought expensive bottles of wine at auctions. So this kid took advantage of an inefficient market where very little information was known. One side had more information than the other. Very few transactions, very few buyers and sellers. So that's a very inefficient market.
I think it's important to recognize what kind of investment you're looking at doing, and understanding if it's an inefficient or an efficient market. And in a lot of markets, there's you can take advantage of mispricings, but that's more speculative. And
realize the risks that come.
There's a lot of risks in that. So why do a lot of people prefer efficient markets? Like, why do people invest in a stock market as opposed to investing in something like a cheap wines market, like Ryan just said? And that's because an efficient market creates prices that you can really trust. You can trust that those prices are fair.
You can also trust what's being bought and sold is a real product.
Yeah, and it doesn't have to be just the stock market, but the stock market's one of the most efficient markets. The public bond market, the S&P 500. These are really efficient markets because there's thousands, even millions of shares traded for these securities every day, and two people are agreeing. Millions of people are agreeing on the price that's being exchanged that day. Think of like the in Seattle, there's a really famous fish market there, the Pike Place Fish Market. Yeah, right. And so if you're going to buy fish, let's say you're trying to buy salmon at a fish market, and there's like 17 different vendors of salmon. Yeah, I mean, and they're all basically harvesting from the same source, meaning the same area,
the harbor,
and they're all bringing you the same fish and piling it on different tables, and you're walking place to place to place. There's not going to be like a lot of
big price discrepancy.
Yeah, there's not a big price discrepancy because everyone knows,
and it's not likely that the salmon is really like some crappy catfish or something.
It's not likely.
I wouldn't.
You can see it. I think the orange one would look better than the gray one.
With whiskers.
Okay.
Yeah, you should be able to tell. But that's also kind of the point. You know what you're getting.
Totally. And I just think investors prefer efficient markets, or let's say people that choose to invest in efficient markets are partially doing it because they just want more safety and security.
And it's easier.
Yeah.
I mean, the barrier to entry to buy a mutual fund is a lot different than trying to get in on some private deal that.
Yeah, and you just have less regrets. there's less opportunity for regret. Also, less upside. Okay,
it's fair.
So let me show you an inefficient market that I came across this week. All right, there is a piece of land on a major highway right now that is going to be purchased by the great state of Utah, and they have to purchase it because they're putting in a new road. All right. And there's a few people that know that this is going to happen. Because they have connections with a senator or a congressman or someone in the government.
Why does this story sound familiar? Like it's happened a few times.
Like it happens all the time in every state.
Yep.
And so in that kind of situation, someone has both illegal and insider information that they are going to try to exploit to take advantage of something, and they're going to act on it.
Yeah.
And you could act on that information by saying, okay, I'm going to buy this piece of land and I'm going to just park on it and refuse to sell it.
How did I know that the city would put their major railway right through the center of this and build a shopping mall and a bunch of condos? I had no. What a lucky.
I mean, things like that happen a lot where someone actually has insider information. That's not legal information to have. And that's
so if you're excited about jumping on the deal with maybe the government official or the person that works for the construction company that knew about the project 5 years ahead, be careful.
Be careful about that. That's illegal. Second, if you think about this, happens a lot in public companies, and a lot of people go to jail. I.e., one of our dear friends of the show, Martha Stewart. Okay,
shout out to Martha.
So anyway, recognize what kind of market you're in, and rather than thinking, I better get on this opportunity before it slips away, before it gets away from me, think about, how does this actually fit in the context of my plan?
Yeah.
Does this fit in the context of my plan? And do I need to do this in order to reach my goals?
Is this going to be really expensive? Is this going to wipe out my liquidity? Is this going to put me at risk to lose other things that I can't afford to risk? Is this going to make me stay up at night, worrying and stressed about whatever? Is this illegal?
Yeah.
Yeah.
I think a lot of people will feel like they want to be opportunistic at some point in their life, and there's nothing wrong with that. A lot of people have to do that in order to build companies.
Well, that's fair. I mean, some of the greatest things that have ever been built were from risky ventures,
mispricings. Right.
Sure.
I mean, that's entrepreneurship, and to some degree, it is very healthy, and that's a part of our economy. We're just saying that all these investments are not comparable, and you can't compare an efficient transaction like buying fish at a fish market, where you know that you're buying something that you're confident in the price, and then something that doesn't have a lot of information, something that you're kind of an insider in.
You're in the Arizona desert and you're at a clam market and you're buying clams.
Oh, wow. Yeah. I mean,
there's one guy at a stand in the desert, Right. Like, is this worth the price I'm about to pay? Is this a real clam?
Totally.
You wouldn't know.
So I think,
do you think there's times when people think that they're investing in an inefficient market when really it's actually efficient?
That's the mistake. That's a good point, man.
Like their local real estate market, and they think that they've got the inside track on a property.
Well, that's the mistake that's made.
But then they realize, what they don't realize is that you've got all the developers, all the real estate agents, all the investors in their entire market have access to the same information, but they just don't realize it.
Yeah, totally. That's actually, I think, really common. People do that. I mean, the probably the most famous example of that is people do that on a daily basis with the public stock market.
Yeah.
I mean, that's where it happens all the time, where people feel like there's an inside track, or I know something that's going to happen that someone else doesn't, and I can take advantage of this thing. It happens a lot.
Yeah. I think a lot of times, like Q said, that the real estate market is perceived as one that's inefficient, right? And there's not, in every city, I would say the real estate market is less efficient than the public stock market.
Fair, yeah.
It's much less
number
efficient.
of transactions and volume, yeah.
Right, but it's still quite an efficient market.
Yeah.
Especially in major metropolitan areas where there's a lot of buyers and sellers.
Yeah.
It's probably a little less efficient out in my hometown of Rupert, Idaho, where the farmland might not have quite as many buyers and sellers and quite as much. But as I look at that still, when I talk to people that live there, I mean, it's even farmland in a rural area tends to be fairly efficient because people are looking for land on a regular basis. Yeah. They're trying to find an opportunity and getting a fair price.
So an acre in the middle of your city, you probably didn't discover the gem that no one knows about, and you're about to uncover the treasure that...
Yeah, and I think I would even say that a lot of people, the real mistake is made when they find a piece of land that hasn't been developed and hasn't been taken through the city and isn't entitled yet, but they feel like the price they're getting this raw land at is so inexpensive that there's a massive amount of markup.
Now, someone in that transaction is taking advantage of a lack of knowledge, and it's the person selling you the land because you don't know how much it's going to cost.
Yeah, and there's a reason usually land isn't developed, you know? To close out, I'd like Ryan to kind of share a story about an article that he's read recently that he liked.
Yeah, this article was, it's called Why Smart People Make Bad Decisions. It was from collaborativefund.com, just to give some credit
here. It was National Geographic for Kids.
Yeah, no. Why Smart People Make Bad Decisions. A guy I follow on Twitter, a really smart guy named Morgan Housel. Anyway, this article pointed out 2 reasons why smart people tend to make bad financial decisions. One is because intelligence increases the ability to fool yourself with elaborate stories about why something happened. The first point they made was that intelligence increases the ability to fool yourself with elaborate stories about why something happens.
Okay.
So there's a quote in there, a line from the article that says, when you're blessed with intelligence, you're also cursed with the ability to concoct intricate and often false stories about why things happen. The second point was that intelligence pushes you to the idea that and I like this one a lot, pushes you to the idea that complex problems require complex solutions. And if you take that in the point of a dentist looking at, I've got 30 years to build this practice and I got to save money, I got to pay off my debts and retire, that seems like a really complex problem. And a lot of times it can feel so overwhelming, and especially being an intelligent, well-educated dentist, you can feel like the solution must also be really complex. There's so many moving parts and things that have to happen that the solution is really complex. There was something in this article that said the irony of some of our biggest problems is that they have solutions too simple for the people working on them to find intellectually stimulating, which I think that probably explains half the people on financial media that are just obsessed with trying to beat the market and exploit inefficiencies. The other way is just too boring for their really smart brains to want to do that for a living.
Yeah. I think one part of that, too, that I thought was really interesting was a part of the article said Albert Einstein, Warren Buffett, and Steve Jobs are all brilliant. But a lot of people are brilliant. What made them famous is their ability to distill complexity into something elegant and simple enough for the average person to understand or even use. And I think that's really what is challenging about a good financial plan and a good overall financial strategy is that most financial advisors can't boil it down to something as simple as it needs to be. And they overcomplicate it, and consequently their clients end up feeling a little confused about what's even going on with their accounts. And it's not a durable, lasting solution. So it doesn't allow people, like you said, sometimes the simple solutions aren't really intellectually stimulating.
They're very fun to work on.
Some of the smart people just don't want to do the boring path.
Yeah. Well, there was a part of that article too. Sorry, that they were talking to an MIT cancer scientist, and he was saying, really, we could solve a lot more problems by just getting people to quit smoking, which is psychological. He's like, but that's not very fun for me because I want to talk about molecules and cell structure and how cancer spreads. And my solution, we can actually do more with a simpler solution than someone like me could ever do in a whole lifetime.
Yeah, that's interesting. Well, keep in mind these 3 principles we talked about today. They're always going to hold up whether you're smart or whether you're just average. Okay.
So we'll do a podcast another day for how to know if you're smart or if you're just average.
Average.
I don't want to know.
First, don't try to predict returns. Second, don't get caught up in the hype. And third, think long-term instead of being opportunistic.
Okay. Thanks, Reese. Thanks, Q. Thanks for everyone for listening. We would love if you could take a minute and review us on iTunes. Just hit that little thing that says rate it and give us some stars and leave a comment about how much you love Reese's voice in the mornings when you drive to work.
Oh, boy.
Yep. You can visit us online, dentistadvisors.com, to book a free consultation. There's a link at the top. Or call us at 833-DDS-PLAN. Thank you, everybody.
Thank you. Carry on.